like look at your mirror settings in your camera, and you can just flip it over. You can flip it to the other
Oh,
side.
see, that's why they pay the big bucks. I got to figure all
There
this
you
stuff
go.
out still.
I
But
don't know
all
if it
right, everybody.
actually changes it on the screen, but whatever. I could change mine. Let me see if.
I don't know. Anyway, everybody, welcome back to Cashflow Chronicles. We're upgrading here. So Kris is teaching me how to be a person in the 21st century. I don't know if I like it. I don't know if I like it, Kris.
Did it work? Did it work?
It did. It did work though. It did work.
Okay.
So
So
people got
now
to
I'm
let
on
us
the
know.
wrong side.
Do
I'm
you
on the
want to?
wrong side, but I don't know if it's live streaming in the wrong direction.
That's a good question. I guess we gotta. Oh, it is. It is live streaming in the right direction. Well,
Okay, good.
the opposite direction. Well, you just switched it as. Anyway,
Gotcha. Yeah.
we're live. We're back. We're back from Thanksgiving. Kris, did you have a good Thanksgiving? Did you have a good break?
Absolutely, dude.
I went MIA, man. I woke up this morning and I was like, I actually feel rested, even though there was the normal family banter going on over Thanksgiving. I still was able to get a little good bit of rest, which was awesome because I realized that I'd only taken like a week off throughout this entire year so far. So good to get a little bit of some time back, and good to hang out with family and all that as well. So I have a question for you. I'm going to spring this on you. Are we finally going to talk about Atkore today, or do you have another MO/agenda that you want to?
We can talk about Atkore today. Actually, let me bring it up. I think we've been
avoiding it,
neglecting.
Yeah.
Well, let me bring it up, and then we can go. Let's just do some general market talk, and then we can actually go on Atkore and then talk.
Yeah. So some general market talk. So Bitcoin is up just under 38,000. The market's been holding in rather flat. It's been rallying, I guess, a little bit last week, and it's been holding so far this week. And so far, so good at 4,500 and almost 60 on the SPY. Qs are looking pretty healthy as well. Oil prices are down to $76 for US WTI. Natural gas $2.70. Nvidia is retracing from 500. Bros is about to go back over 30, so pretty excited with that. Apple's kind of hanging in there at the 190 resistance there.
Did you have our portfolio, by the way, or
yeah, I can pull that up in the background because I didn't check it today. I know it was up, but I don't know if we broke 700 or not. Amazon has been on a tear, man. What do you think of? I don't know if you guys talked about it much on FJ. Did you guys talk about the Q release that they did on Amazon?
You mean the Q release? What do you mean?
Yeah, so it's like their kind of version of Palantir's Foundry almost. Like they're going to be looking into AWS and how you can implement AI into some of your AWS and all that sort of stuff. I haven't read too much into it, but it seems like it's going to be like a Salesforce, Palantir Foundry-esque sort of competitor. And so people are like, oh, is this the end of ChatGPT? I just read a small little article on it, but it's something I'm going to be diving into and looking a little bit more into because that could have implications on Palantir. So just curious if you'd heard about it yet.
No, not off the top of my head. I haven't really dug too much into it. I've been more focused lately on just some of the macro level things that I'm seeing. I'm just trying to piece together what I'm hearing on CNBC versus what I'm seeing in reality. I'm looking at the numbers and just, coming to a good conclusion on how to position the portfolio for 2024 and 2025. I think the main topic that guided everything in 2023 was inflation. I think 2024 and 2025 could see deflation as the main counterpoint. So, it's just like I said, I'm doing more like macro level research and just macro level getting a macro level understanding, so that this way the portfolio can benefit. So
I'm curious. I hear a lot about what people have been talking about with respect to nobody was showing up at Walmart or nobody was showing up on Black Friday. Do you really believe that? I feel like at the same time, the numbers for Black Friday and the numbers for Cyber Monday and everything like that have been really well received, right? So I just trying to understand from a headline number what CNBC is saying out there. They're like, oh no, nothing's been all that great. Nobody's out and getting the deals anymore. But at the same time, Amazon had really strong sales. A lot of these e-commerce businesses had really strong sales. So I'm curious what what your thoughts are. But I also did see some CNBC news articles about specifically deflation, specifically back onto what we're talking about with Black Friday and Cyber Monday sales. They say, well, it's up, but comparing to the amount of inflation that's been in the economy, it's not up enough to account for that. So technically, if it was only up like a couple percentage points, well, if you think year over year inflation was, 6, 7, 8%, well, in reality, in real terms, volume is down. So I'm curious to hear what your thoughts are.
No, I think that's one of the key things to look at. I think too many times people just look at the gross total volume of sales and just use that as the benchmark. Whereas I think a better benchmark would be in relation to current inflation rates, current GDP, like current spending by the average person. Are they spending more? Or are they spending less? Because I mean, if you were spending $500 on a TV in 2020 versus you're spending $500 on a TV now on an aggregated basis, technically speaking, you're actually lower because you're not buying as many.
TVs aren't a good example, man. We know they're always deflating in price. Right?
Yeah.
I'm just joking with you, but
I'm just saying as a core product. So I like I said, I don't think that the consumer is nearly as strong as a lot of people are thinking. I mean, in total dollar terms, it was nice. It was a nice headline that a lot of these companies put out there. Like, oh my God, look at all the sales that we did. Yeah, but did you really? So yeah. The other thing is a lot of the products that they were selling. That's another thing that we just have to be very careful in looking at. Like, were they big ticket items that might have been, more pronounced with the sales, like a few years back, where these just like smaller items, it's just more people. I think the one thing that throws a lot of people off their game is that the amount of transition to e-commerce far outweighs the negative impacts of a recession on something like Amazon. So I spoke to a few people, and they're a little bit like short-term bearish on Amazon and companies like Shopify, because like if the consumer weakens, that means that their sales will go down. And my thing is, no, I think there's still a lot of room for transitioning to e-commerce and more selling on the e-commerce platforms. And so companies like Amazon and Shopify will keep doing well. I think the other ones are going to take a bigger hit. So companies that are more like retail focused, where there's a physical presence. If you look at all the videos that came out around this Black Friday, there weren't lines. There wasn't like, oh my God, a ton of people in the stores just, knocking at you. Remember almost like 10 years ago when Black Friday came around, you had people sleeping outside in tents to get some of these deals. I did not see any tent sleeping this year. Did you?
I did not. No, I mean, I didn't really go out much personally, but I know exactly what you're saying. I mean, I'm used to seeing headlines on the news about people lining up and kind of that almost like pregame of Black Friday before everybody was kind of the stores were opening up, and like looking at a lot of the news outlets and stuff like that, they weren't really showcasing that. I don't know if that's just the spin, but I personally didn't hear anybody saying personally, maybe it's because I'm a little bit older. All my friends now are getting into their 30s, so maybe they're like, I'm not staying out. But I knew back when we were in our 18 or early 20s, probably like 10, 15 years ago, I knew friends and family that would go out, and camp out, not maybe like overnight, but they'd definitely be out, a couple hours early just to make sure they get the newest shoe or they get the newest deal that was going on at Best Buy or something like that. So I don't know. Maybe it's just because e-commerce has become such a thing. I really don't know, but it was pretty interesting to kind of see a different perspective. But you still hear Amazon saying that, they had some of their best sales to date. So curious to see how that kind of goes forward, considering, a lot of people have fourth quarter as their number one because of holidays like Thanksgiving, Black Friday, Christmas, to have that extra oomph to their fourth quarter. Amazon being one specifically, and many other companies being one. So anyway, just some thoughts there.
Yeah, and I agree.
Trying to see if there was any. I saw a really good one on CNBC, and I can't find it now about specifically this topic, but I can't find it anymore. I guess we'll have to.
So let's take a look at the portfolio and just dissect where we're looking at, and maybe maybe do some rebalancing if necessary.
For sure.
So the first one is just Abcellera. Abcellera is it's a lotto ticket into the future, man. I'm not selling this thing. It's sitting in, I told you, some unnamed account just getting piled on. So I think there's the value of Abcellera is it's like investing in a venture capital fund, right? Where I
Right.
think eventually one day this could be a really big thing. AMT is doing well, which is American Tower. American Tower is a tower REIT. I don't know if you noticed, but there's actually been some activist investors jumping into Crown Castle, which is another tower REIT, and so that's why you're seeing a lot of price action in them. So even on top of the dividends that we're about to get, I think next in a couple of weeks,
Yeah.
those things are going to be nice to get a nice 2%, because that's how crazy the dividends are right now. You're getting 2% a quarter almost, but not for AMT. For CCI, I think it's almost like 7. So you're getting about 1.75% in dividends per quarter, which it's freaking amazing. And I think there's a lot of value there. Same thing with Verizon. Verizon's going to give us a nice little chunk of money that'll get deposited into this account. What's the current what is that thing called? Rate that we're going to be getting in this portfolio right now?
You mean the dividend yield?
Yeah.
I think last we checked, it was like going on 2.5% or 3% or something like that. But
Okay.
I could always just
Not bad.
double check in the background. But I think we're going to be getting like crap. It was a couple $100, and not a couple $100. It was like
one of the things,
couple tens of dollars.
One of the things that we got to do is switch to StreamYard, man, because this stupid app doesn't let us comment in the chats. Where at least the StreamYard, you can link your YouTube, your Google account, and you can actually chat back. So Chaos Perez, he just said, Kris, I wanted to let you know I added my first dividend stock, Verizon, 1,000 shares. Thank you. Hopefully you read my comment. Yeah, man, of course. I hope you do well on it. I'm in it pretty deep. So, let's get this money.
Yeah. Hi, Kris. I'll continue to see. We have 2 shares of that and up 4%. So I'm just kind of curious. We're up close to $691, and we're tracking this month, Kris. I think just with consistent continuing to do Cashflow Chronicles, we're on track to make like $300 this month that we'll be adding to the portfolio in December timeframe, which will be a lot of fun. You and I also discussed a bond that we might be looking at as well. And now that I'm, so I told Kris, I was like, I don't know, we just have to wait a week or two so I can balance everything. Being in a house now, I have to make sure all my finances are in order, and all the different timings of when my money's coming out is different than what it used to. So I think now that I've got a little bit of another week under my belt and another paycheck, I think things are good. So him and I can kind of elaborate that. Maybe we can figure that out tonight after this stream, or do it tomorrow. But that should be fun as well to look at. But I'm curious, do you think that there's any other stocks in here that we really need to potentially move? I think TLT, it's still too early to let go. Abcellera is one of those long-term hits. Bros is way too in its infancy, so I think that's got a little bit long ways to go. I think all these are probably still too early to trim.
Maybe Disney, only because I'm not liking some of the things that I'm hearing coming from management. Their cash flows are still there. This could still be a really good turnaround play.
But you might have another retracement before you start going up.
Yeah. Yeah, and also just a shift in the business for Disney in terms of like quality content may be something that could wear on them in the short term that I'm not a big fan of. I mean, I think long term Disney's still a cash flow generator. They're going to be doing well, but a lot of the newer things that they're starting to come up with are not hitting, and there's an industry-wide trend where you will see some weakness there. So I think there's going to be at least a longer transition than what I originally hoped for with Disney. So I think Disney could be something that we unload, and we could possibly load back up at a better price in the future. So, I think there are just a lot more opportunities. Someone in the comments section, they put Dividend Chronicles. I'm not normally a dividend guy. I don't typically invest in a lot of dividend companies. I'm more of a capital appreciation guy. The key to investing in some of these companies that have strong dividends is that number one, their cash flows can support the dividends really, really nicely. And because their dividends are so high right now, based on their value of their underlying stock price, if we start to see decreases in interest rates, what's going to happen is a lot of people that are used to 5.5% on their money market and they're not getting 5.5%, they're going to say, hey, I need to buy a business that's generating me 5.5% or 6% or 7%. And that's when they'll start to buy companies like Verizon, AMT, CCI. And that is the alpha that we're going for. So you're going to get not only the dividend income for being the shareholder of the company, but you'll get the capital appreciation for when people start to buy up these dividend players that are paying really high dividends relative to their current valuation. So if you look at Verizon historically, Verizon has paid usually on a yield of about 4%. So this is how dividend investing works. You don't get paid a percent. You get paid a fixed amount for a dividend. And based on that money, you relate it to the current stock price. And that is what your dividend yield is. So right now, Verizon is paying 66 cents for every share. So right now, every quarter, you're going to get as a shareholder of Verizon 66 cents. Whether you own it at $61 or you own it at $30, you still get 66 cents per quarter. Your yield is materially different. If you bought it in the 60s and you get 66%, your yield is only 4%. But if you bought it in the 30s, your yield is 8%. I hope I didn't lose people with that.
You didn't. And I just want to pull up this graphic here because, people were buying this in the 50s and 60s because at the time, zero interest rate policy, you couldn't find any yield out there. So they were bidding up companies like Verizon, AT&T, companies that were paying these yields and getting them down and pushing their yields down to 4 to 4.5%, maybe even lower. Like Realty Income was being pushed up massively due to the fact that there was zero interest rates to be had in any Treasury yields or Treasury bonds or anything like that. So they're putting their money into something like a Realty Income to be able to get those yields, right? And same with a Verizon. Then when you notice that, money started getting easier from an interest rate perspective. Obviously, getting money was harder, but actually getting rate on your money was easier. You start to see when the interest rates started to rise is when Verizon really started to take that hit because it was easier to take money out of Verizon for risk-free growth and put it into something like a Treasury bond. And now that you're kind of in this reversal, you're going to hopefully see a pop in what Verizon's price is going to be. And that's the same thing that we're trying to do with TLT, right? TLT was popping up very heavily, which is the 20-year Treasury ETF. It's the same exact sort of thought process as, TLT was mooning when interest rates went back down to zero over the past 5 years. We can see they kind of maxed out here in the 2020 timeframe. Then when interest rates started to rise again, people were saying, well, shit, the actual value of what they have in this portfolio, because it is a rolling sort of 20-year Treasury bond, is kind of decreasing. So once you actually start to cut interest rates, the hope is that you kind of go up and to the right again versus where we were kind of going, which was down and to the right over the past few months, if not quarters, based off of the rates being where they're at. So hopefully we can start to see a flattening out here and then eventually a reversal back into hopefully the hundreds or so. I don't think we're going to get back to this 140, 160 because that was when interest rates were zero. I don't think we're going to go to zero unless something very drastic happens in the economy. But I'd anticipate that the yield of this increases over time as well. But we'll probably start to hit a little bit of a wall as rates start to get cut as well.
Yeah. If you want to just share something real quick that I put up there, what I'm sharing right now is actually where a lot of funds ended up going in the last quarter. So a lot of money went into money market because money market is a safe way to guarantee, like right now, 5.5, almost, yeah, 5.5% yield. As the Fed starts to lower interest rates, this is going to go away. This money is going to be start moving into other things. Now, the thing is, some of it's going to move into fixed income. Definitely, people looking for yield are going to go there, but even fixed income is going to start to go down. So a lot of people that have risk equity tolerance, they're going to be buying up assets that have equity like features, which is you have your dividend growth, but at the same time provide an excellent current dividend. So I think right now there's just so much money that's sitting on the sidelines that eventually it's going to make its way into the markets, and I think this is where it's going to go. So like right now, based on the current data, there's about $5.8 trillion sitting on the sidelines.
Yeah.
$5.8 trillion. Where is that money going to go? It's something that we're going to probably have to cover on here pretty regularly and just see where the monies are inflowing and outflowing. So definitely going to outflow from money market, but where is it going to go? I think it ends up going to companies like Verizon that have, better yield situations for people looking to generate alpha in both the equity premium that they can get, but also the dividends that they can get. And I think a lot of the people that have money on the sidelines, they're not exactly the millennials. They're not exactly the Gen Zers. They're still in their income earning years. I think a lot of that money is with baby boomers,
Yeah. Yeah.
And so the baby boomers, they're not into, hey, I want to buy the new hot stock or the newer stock. They're more like, hey, I know Verizon. I use Verizon. I could buy this company. So I think a lot of people are going to be piling into as something that I called in the finance junkies, dino caps. I'm not the one that coined that term, by the way. There's other people that coined it, but it's just funny. So dinosaurs. So I think a lot of people are not investing in dinosaurs. Me, even though I'm young, I'll invest in a dinosaur.
I think there's something to be said though that we're in a phase now where we're not at zero interest rate, and so even just keeping money market funds might be enough for some people, right? Where even the $66 that we have just sitting on the sidelines in our YouTube Moolah portfolio is getting a 5% yield on its own, just sitting in money markets. So if you're thinking about it, it's like, well, why compete with if you think that there's capital exposure risk and owning something like a Verizon? Say you are a boomer and you're about to retire, and you're sitting there being like, well, do I really want to buy a Verizon and the share price might continue to dwindle, or do I really just want to have this 5% yield? I know a lot of people out there that are afraid of the stock market still, and that might be a reason why there's such a large amount of capital on the sidelines, is that 5%. But as exactly Kris is saying, that money market fund goes back down to 4%, to 3%, to 3.5%. At what point are they going to say, the capital exposure risk just to get that extra 1 or 2% is enough for me to start entering the market? And that's exactly what we're talking about. It's going to push things up like Verizon. It's going to push things up like TLT and something like. And I want to, Cameron asked in the comment section, you said, or in the chat box, he said, well, as yields rise, isn't the price of TLT going to go down? And that's exactly what's been happening over the past 18 months. But here we are in the break of potentially cutting rates in the next 6 months. The exact opposite effect is going to happen, right? So as we've seen a lot of these companies start to decrease in share value, like Realty Income's probably a good one to potentially look at as well. I know some people don't like it, but you can see since it started to kind of come back down.
The sticker symbol is O. The sticker symbol is O.
Yeah. So, there is the piece of the pandemic playing into this as well, but commercial real estate and other things kind of pushing this price back down. But I anticipate, with a lot of the real estate investment trusts have been getting hit pretty hard just based off the fact that there are debt vehicles and, anyway, going down more of a rabbit hole. But I think a lot of these companies have been getting hit hard due to yields going up and interest rates going up. We'll see a reversal. Verizon specifically, I think NextEra Energy will be one. Master limited partnerships that use debt to grow will help have a little bit of a tailwind as well. There's a lot of different companies.
Yeah, I think that that's the other benefit too. So a lot of businesses that are capital intensive, that require a lot of upfront capital, they're loaded to the hilt with debt. So for them, you know, the reason why they've drawn down almost 50%, like something like a Verizon and AT&T, is because they've had to do all this capital spend. So now people are like, well, don't they have all this debt? So all the concerns about the debt start to kind of like go down a little bit too, because as the interest rates come down, it's like, oh yeah, they can refinance at lower rates. Cool, not a big deal, you know. And so overall, I think that there's another part to the growth story with something called a FWA for Verizon also, that like provides another layer of safety for me. But I think eventually, given where we're headed into this market, companies like that'll eventually, retrace back to their mean again. They'll be back at the fifth, maybe not to the same extent the 60s, but at least to the 50s and 55s. It's just inevitable. And then at the end of the day, they're also going to be able to grow their dividend because their business is still resilient. So as they grow their dividend, that also means that the stock price should come in, go up in value as well, right around with it. Someone said VC over O. You know what? I agree. I'd rather own VC over O. I don't know about you, Matt. VC seems O just has so much exposure to like the drugstores and the what are they called, the movie theaters, and every time I go to these movie theaters now I see them completely empty. I don't know how many are actually going to survive, so I'm not a big fan of that. But on the other hand, VC only owns all the Vegas properties, so I'm
Yeah.
actually more into VC than the other guys.
Yeah, Vici. I don't know if it's VC, Vici. It's a Joseph Carlson
Vici,
special,
yeah.
and he's been preaching it for a long time. And he's more of a, he doesn't necessarily only focus on dividend stocks, but he definitely has a large portfolio, specifically Vici kind of properties being one of his big ones. And these guys, if you think about it, if any of you have gone to Vegas and see the amount of property that's there, I think that it's a good one to potentially look at. And it actually doesn't trade at too expensive of a price to funds from operations. This thing actually throws off a good amount of cash as expected. And so I'm kind of curious, they continue to do a pretty good business there and continue to buy more and more properties. And actually, so much so, I think that it's been so lucrative that you actually saw Realty Income buy into a little bit of the Bellagio last quarter as well to try to diversify out of specifically the convenience stores they've had. So I wouldn't be surprised you see more and more companies go down this route of specifically looking at casino properties, because casinos don't go away, right? They just trade hands. So that a company might go bankrupt or casino might go bankrupt, but it doesn't mean that the property is going away. It just means somebody else is going to take it over. So we've seen that forever in Atlantic City. We've seen that forever in Vegas. So, it always changes hands, but the property doesn't get knocked down. So that sort of property is something that would be good to hold going into the future. So maybe one of these episodes we could take a deeper dive into Vici.
All right. So without further ado, let's look at Atkore. For those that don't know, one of the themes that I'm trying to do a little bit more of now is just looking at some very undervalued small and mid cap companies, because there's been such a ride up in the Magnificent Seven and the large caps, and small and mid caps have not necessarily fared as well. So I think the valuations sometimes can be very compelling. So there's one company in particular that I feel is very compelling. We can take a look at it together real quick. So let me just share my screen. This company is called Atkore. Actually, hold on. Let me pull up the other thing. 1 second. Share.
Ticker symbol ATKR.
Yeah. Okay. There we go. So Atkore actually they're an industrial where they actually make a lot of industrial grade things. So I'll just show you guys exactly what it is. And these are things that are all around us. These are things that people don't necessarily like think about, but they're everywhere, right? So if you look at like wire baskets for wires going in and around a data center, this is the company that usually can make stuff like that. Electrical prefab, electrical grids. conduits, anything and everything that basically, when you're building a building, you need in order to make it a functional building, these guys make, right? They're a $4 billion market cap company. They have excellent products that are just industry grade products. All their stuff is made in the United States. They have a great supply and logistics business that complements this. So they work directly with contractors in order to sell them the products, and the contractors use them to build out the infrastructure and stuff. So um overall, they're just a very well run business, in my opinion. One of the fundamentals of their business is that they do a lot of acquisitions, where they will bolt on an acquisition of a smaller company and use their products to basically optimize it and sell as part of their core offering. So a good company that they bought not too long ago is called Unistrut. So anyone that works in the electrical industry, they might know Unistrut. But Unistrut is a great company that they were able to pick up, and it's one of their leading sales figures right now. But what's really compelling is just their numbers. So before we go too deep into things, I also kind of want to explain what their current weaknesses is also, and why they've been taking a beating in the short term. So let's run through the numbers first, okay? So in 2018, they were generating about $146 billion in cash flow from operations. They've been able to grow that successfully to almost 453%. So it almost ends up being about $800 million. Now, remember, this is only a $4 billion market cap company. All right. So that is a lot of cash flow for a very small company. They've been using that to pay down a lot of debt. When you do acquisitions, you take on debt. They've been able to go and reduce down their adjusted debt to almost 0.7%. So basically the debt is there, and they don't have any near-term maturities. So if you can see this right here, they don't have a lot of debt on the balance. Well, they do have debt on the balance sheet, but it's nothing that's going to impact them anytime soon. But what I really, really like is the amount of share buybacks that they're able to do with this enormous cash flow. Their cash flows are very strong, and they're just buying back shares right and left. And then also now they're introducing a dividend, because they, like I said, if you have the cash flows, you can do stuff with it. So one of the things that they highlighted right here was that they were going to add a quarterly dividend program starting Q1 of 2024. So right now they've done over $990 million of stock repurchases since November of 2021. So if you think about it, that's a quarter of the company that they bought back. Just freaking crazy, right? They're going to have a very disciplined approach to how they're doing their capital allocations. Same thing with their capital expenditures. So overall, I think this is a great business. Their cash flows are very strong, and they'll be able to keep buying back those shares and just generate more and more value. The part that I would say is not good for them in the short term is that 2022, they had an unusually strong year, primarily because there was a lot of supply chain issues from China. And so a lot of the products that they had were bid up like crazy here in the United States. So because of that, they were able to extract higher margins for these products, and they were able to just generate a ton more cash flow. But that is starting to kind of like dissipate and die down a little bit. But what's kind of good is that it's starting to become more stabilized. So before, their EPS was about $21 in 2022. Last year was $19. And what they've guided for is about $16 to $17 a share of EPS going forward. And the goal in 2025 is to get to about $18 per share. Now, if you do the math really quickly based on today's share price is about 120, right? So if you have almost $18 of earnings, you're looking at a PE of about, what is that, 6, 7, with a company that's still generating a crap ton of cash flow that they're using to buy back a crap ton of shares. So Yeah, that is the basically the alpha that I have. And so they actually gave some guidance on some of the areas that they're going to be doing well on. So right here, progress and capital projects. They're going to be onshore. A lot of businesses are doing onshoring route now, so they're manufacturing more things in the United States. So they'll be able to grow their factory business. So as a new factory goes up, it requires electrical conduit, piping, and everything else to it. The Inflation Reduction Act, that is boosting domestic manufacturing, which helps them. The thing that hurts them is something in the short term that's not good, which is higher interest rates and mortgage rates. This is something that is going to impact them a little bit, because what happens is not a lot of people are building more commercial buildings, right? So if you do a commercial building, you need a crap ton of piping, you need a crap ton of wiring, you need a crap ton of conduit. Right now, you're not seeing as much construction. So that's a negative in the short term. Also, same thing with housing. You may not need as much conduit and piping and everything else if the number of homes that are being sold right now are not that high. The telecom industry delays for HDPE. So right now, telecom, when you have phone lines and fiber optic lines going from place to place, you need conduit to properly place it into the ground where it doesn't get, like flooded and contaminated or damaged. These guys usually sell the conduit that goes around there. So right now the telecom industry is kind of contracting their spend a little bit. So like Verizon right now is guided for a lot lower capex because they've built out their infrastructure over the last 2-3 years. So that just means that there may not be as much demand for some of their products in the short term. And right now they're actually having still trouble finding labor, and some of the challenges around that. So I think overall these are things that these guys will be able to get over, and they'll be able to benefit in the long run. And I think as shareholders will be, we just have to wait and relax and see the returns on the other side. So,
yeah, it's a pretty interesting one. I didn't realize how much revenue that this jumped out at. I think the thing threw off. I think the thing that might bother me a little bit is how fast that they grew. So like in fiscal year 2019 versus fiscal
it's acquisitions. That's the key, right? Acquisitions. They were able to acquire some businesses that actually have a lot of income generation also. So it's not necessarily just, oh, look, they just started to become really, more cash flow heavy. It's just that they were able to integrate a business into itself. Yeah.
And that's where I'd have to do a little bit more due diligence, right? Because it's like, I'd have to look at exactly what the companies that they acquired. I mean, obviously they're going to grow a little bit as well, with the synergies and stuff of the like. But the question is like, did they acquire a $100 million company here and a $100 million company there? And it literally is just the fact that they acquired new businesses that allowed them to really ramp up their earnings per share from like $4 to the $18 that we're expecting kind of for fiscal year 24. Or is it something where, okay, that gets you from $4 to $10 and it's all the synergies that allow you to get from 10 to 18, coupled with the increase in just overall business that they're getting. So that's where I'm kind of just needing to go back personally and do a little bit more work about understanding.
Okay. So here's what they have acquired lately, and maybe this will help. Share. So these are the businesses that they acquired and integrated into their core offerings. So these are like I said, smaller companies over time that they had. The one that really excited me was Unistrut. Maybe that was a long time ago. But basically this is what it is. So they do a lot of roll-ups. So these are the companies that they were able to acquire and integrate into their platform. So
I'll have to do a little bit. I'll have to do a little bit more and kind of understand how much added to each business. But they did do, seems like a pretty quick transition of a lot of different businesses, all really in the 2021, 2022 timeframe. But there are some in here that are 2017 and 2018, 2019 that kind of explains that big hump that you started to see in 2020, 2021. So interesting. So do you have a large position? I'm curious in terms of like size of the position.
I don't. I'm building my position out. I think this is going to take a pretty good amount of time in order for this to become a bigger player. So I'm just methodically adding, I'm dollar cost averaging into it. This is not a quick turnaround play. This is not a play around, hey, if interest rates start to go, the other direction, that this company is going to do exceptionally well and double overnight. But I think if you want to bet on a small to mid cap size company that is doing well financially, over time, I think the alpha is there. So yeah.
And do you think that that's just specifically because you feel like it will go through these growing pains in the stock price because you're going to have a retracement in the earnings per share over
Oh,
time?
yeah,
Yeah.
yeah, yeah,
But do you think that, I mean, at least from what it looks like, the earnings per share has been kind of flatlined. It's really just been the earnings overall, the revenue overall has been slightly retracing, obviously, because of the 2021 timeframe that you're kind of talking about, how
yeah.
prolific that was with the supply chain cuts. But it seems like that
Mhm.
those buybacks have really offset, the earnings per share
Yeah.
decline and has really made them flat. So I guess I'm kind of curious is if you really think the price will actually go down for Atkore, or do you think it'll continue to kind of just remain flatlined over time?
No, no, I think over time they'll actually be able to grow their revenues. It's just right now we're in a challenging environment where construction's kind of come to a standstill a little bit. Not a lot of people are building commercial buildings right now. Housing construction is there also, but it's like it's not as crazy as people think. So there is something to be said about the data center side because data center construction is still going strong. So I think each business is being offset here and there. So the growth is more muted than declining. And the thing is, especially if you're coming off of a strong year prior to it, the numbers are going to look not as good, right? But in my honest opinion, this is definitely a value play with cash flow because they just have so much optionality with that cash flow. So if you look at AutoZone, you're the one who showed me, it was like the cannibal where they were
Yeah,
able
man.
to grow their revenue 2x, but they were able to grow their share price 10x. So I think that's my key thing with these guys. So if you look at their share count, their shares outstanding, especially the last like 4 years. Hold on, let me just shrink this in. Look at the share count.
Yeah.
It's just constantly being bought back, bought back, bought back.
It doesn't look
So
like it because there's already so little amount of shares, right? What is it, like
yeah,
50,000 shares?
yep. Yeah. So if you look here, look at this on a quarterly basis. This is how much they're literally trimming down about 10% of their shares outstanding per year. So even if their EPS stays flat, I mean, not the EPS, sorry, their earnings stays flat, their EPS is going to jump. You know.
I mean, it makes you think. I mean, what is it really worthwhile to dollar cost average, or do you think it's just better to just throw a chunk into it? Is it really gonna retrace?
The problem that they have is that until they can get back to a point where they can show growth or at least a lot more flatlined revenue, they're gonna take some hits. Like right now, to see earnings where your earnings are down 20%
That's
double
fair.
digits, that's not, I mean, the revenue especially is not good. But once again, it's coming off of a very strong year prior to prior year. So that's what it is. So by 2024 and 2025, I think they'll hit their $18 revenue target. I mean, $18 EPS target. And then people will wake up and say, hey, wait a second, no, this I'm getting $18 per, of earnings and a dividend. Why not be in it? So
Hmm. Interesting one. Yeah, I'll have to think. I mean, maybe this is something that we sell Disney and potentially buy this. I mean, we'd have enough cash, but that would be a
yeah.
pretty significant amount of the portfolio. But I mean, if they are going to start distributing a dividend, you mentioned, did they kind of state how much of a dividend it would be? Is it just going to be like a 1%, or is it going to be
I don't
something?
think they published that yet. But let me double check because I
Because
haven't looked
Disney
at
said the
them in a
same. They
bit.
said that they're going to start distributing a dividend, but not necessarily
Yeah.
today or tomorrow. It might be in 6 months or so.
Yeah. I don't think they mentioned it actually. Let me see. Maybe they have. As far as I know, I haven't seen it, what the dividend is gonna look like. But
And
yeah.
let me, while I'm at it, let me just go to the dividend view of our portfolio and explain to people how much we're expecting in dividends. Because I couldn't speak to it much earlier because I wasn't. So at the moment, we're looking at about $20 a year, which isn't a lot, right? But this is going to continue to grow. But that's not including the 5% that we're getting on our cash, which is about 10% of our holdings at the moment. So add another $3, $3.30. So we're close to like 23, $24 in annual dividends at the moment. So $2 a month. So hopefully we can get, the fun thing is when we get this thing closer to 100,000 and we're churning off, a couple $1,000s a year in income. That'll be the fun part. But right now, I guess you could say that the overall yield of the portfolio, let's just say 23 divided by 691, it's about 3% yield, 3.3% yield for what we have today, which is pretty cool.
Hopefully Verizon doubles, baby. That's what I'm looking for.
We'll see.
Yeah,
we'll see. What price would? Well, two questions, and then I'm curious to see if there's any questions from the audience. There's 110 folks that are watching right now, so shout out to all you 100 people, and continued back-to-back 100 people episodes, which is absolutely phenomenal. Thank you guys for tuning in. The question I have for you, Kris, I know you're big on Verizon. Is that really just going to be a swing trade for you? Or do you think that bad boy is going to be something you hold for the long term? Are you just looking for it to get to $50 and then you're out? What's the deal?
I'd say about $55 would be a good target for me. I'm looking for more I try to look for value. I'm not looking for income. I'm seeing that the possibility of huge amount of capital appreciation in a very short time. So I'm not looking forward to, I think Verizon's going to be, a generational opportunity buy for me. Though I may end up taking a portion of it and just putting it to the side, I just think that there's a lot of opportunity for capital appreciation. And anyone that's been following me that's on the Patreon and stuff, we've been loading this up in the 30s. And so, it's been nice to see, to see that rapid capital appreciation.
Yeah. So. And then I guess my question is for you, going back to Atkore, is there a price target that you're looking to see that you would dump, let's just say?
No. Atkore is a long-term play. I think the possibility for a company like Atkore, especially the stock price, is just massive, so like I don't think that. Yeah. Just like AutoZone. Yeah. You don't necessarily need the revenues to grow with that kind of buying back of the float. You don't need a lot of revenue growth. You just need that capital to keep getting piled back into more share buybacks. That's all.
Yeah. Interesting. Well, I'd love to take some questions from the squad that's in here. I've seen somebody on Twitch asking about things that we've discussed in previous episodes. We've covered Verizon a good bit on the episode that we did. What was it? Cashflow Chronicles number 46. I think that was on Wednesday last week. So feel free to check that one out with respect to the cash flow coverage that Verizon has for their debt and how much additional cash flow they're going to have. So if you're curious about that one, feel free to check that one out. But also some people noting about Uncle Charlie. So unfortunate situation. Unfortunately, Charlie passed away today. So shout out to him. He was a big proponent of Berkshire. I'm sure you guys covered that on Finance Junkies, so I don't want to continue to hammer that one down. Also, there was a question from Scott about monthly dividends versus quarterly dividends. It's not to say one is better than the other. Some folks just like the monthly aspect, especially if they're, say, elderly. Obviously, most people pay their bills monthly. So having a monthly dividend might be more beneficial for somebody that's a retiree, but it doesn't make it more or less secure. And I think one thing that people also have a little bit harder time looking at with respect to those things is being able to analyze payout ratios and making sure that those are safe, because a lot of times companies give out details on a quarterly basis through their quarterly earnings. And so relating that back to the monthly dividend might be a little bit more difficult for people to kind of see, versus if you have a quarterly EPS, you have a quarterly dividend, you can say, oh, the payout ratio is X. Very simple for people to kind of keep track of. But at the same time, there is some companies out there that will try to scam you. I've seen a lot of people that try to scam people with monthly dividends to try to entice people, because people would rather get paid monthly than quarterly, right? And they kind of go down this dividend rabbit hole, and it can be a trap on some of these opportunities. So just make sure that you guys are just cautious about investing in companies just because they might be a monthly or a quarterly dividend specifically. So I don't know. Did you see any other questions in the chat that you wanted to address, Kris?
Just one, which was around like debt for Verizon. Their debt is manageable. I mean, I don't want to go through the entire thing again, but their debt is very manageable. They have strong cash flows that can meet their debt obligations and actually start paying down a significant amount of debt from the CapEx reduction plan that they have going forward. So, like I said, I think a lot of people have blown the debt out of proportion, and it's good because when they make a mistake, we get to profit. So they fear the debt load being, where it is. I think that the business model calls for a lot of capital expenses up front, which then get translated into cash flows later on. And as long as you're able to maintain that, it's not a bad business to be in. So, they're uniquely going to benefit. Not uniquely, they're that's one of the key benefits in a lower rate environment if we get one. So if we're starting to see right now interest rates starting to go down, the floating debt that they do have right now is going to be cheaper for them to service, which means that money is going to go back to their bottom line. And like I said, they have a lot of free cash flow that they can use to pay down debt. So the debt issue is not a problem.
Yeah, a lot of different questions specifically about covered call ETFs and things of the like. Curious about what your thoughts are about any of those. I know we've covered it in the past, maybe specifically TSLY.
Don't touch them. Don't touch them at all, man. That's whatever. People want to make. People don't want to do math. That's fine by me, man. Don't do the math. Just buy TSLY and take your licks like a man. That's all I can say.
Yeah. I think just a quick one just to address that. So Tesla's up 110% year to date. TSLY is down 12% year to date. And so some folks might say, well, but the dividend yield is helping you. It's like, yeah, but you're also paying taxes on that dividend yield too, right? And so in that respect, it's like not only are you having a decreasing term principal amount, but your dividend yield isn't necessarily going to help you keep up with the increase in share price. So I think if you have a company, once you get up to these super high yielding ETFs, it's very difficult for the principal not to get impacted. The ones that I've seen it do the best are the ones that are really chasing like a 4 to 5% yield, because at that point, they're not trying to cap as much of your capital gains or appreciation. They're just literally trying to give you a little bit of extra income. And so in that respect, you're not going to really get that anemic principal growth like a lot of these things that people kind of put into their portfolios.
So someone posted this, so I had to kind of just explain to people, when the math doesn't work. So right now, people, this guy celebrates, says, "Oh, look, I got my dividend payment, yay!" And I'm just like, that's nice, but if you look at your total return, it's not that good. And then someone had to clap back, of course, saying, "Hey, wait a second, like, does this actually make sense? Because you could just take the dividends and reinvest them." And so they actually, did the math, and they said, wait a second, even if you took the dividends and reinvested them with Tesla, just a regular stock, you would be at, $12.95 with TSLY, you'd be at break even pretty much from when it started to launch. So it's like, whatever. It is what it is. I think, what is it? Some of these comments are always fun, man.
Yeah.
To look
you
at.
mean on X, or you mean on in the YouTube chat box?
Oh, bro, the X, man. On X, it's just
fucking Kris always does that to himself. But yeah, I know exactly what Kris is talking about. I think sometimes these people, the problem is when you're kind of doing a lot of this investing on your own, when you're doing a lot of this investing on your own, I know, Kris, you're a mess. when you do a lot of this investing on your own, you learn a little bit to the point where you think you got it and you have it under your belt, but then reality hits you in the face and you realize that you're smart, but you're not smart enough to know what you don't know. And in that respect, something will come out around the corner and slap you in the face that you had no idea was actually going to be a thing. And so I think eventually people initially start off with dividend incomes like, oh, dividends are guaranteed. Like you can literally see the yield that you're getting. But in reality, a lot of companies pay dividends, especially higher yielding dividends, because they don't have anything else to do with the company. Either they're in a mature state or they aren't necessarily in a realm to keep reinvesting because their business that they're investing in is declining. So the best thing to do would be buybacks or just giving out as dividends. And in that respect, sometimes the company itself loses its innovation and loses its will because it's so focused on giving shareholder returns. Microsoft almost went down that route where they didn't invest in, MP3 players, and they didn't invest, and eventually they got back into cloud, which really saved their business. Obviously they wouldn't go belly up because of their operating system, but really it's cloud that's been driving a lot of the gains that you've seen in Microsoft since 2015 for the past 8 years or so. So, you have to be cautious about some of these dividend payers. And it's like, yes, these dividend yielders can be good to an extent, but you really have to look and make sure they're reinventing into their business. Like Verizon's probably one that you could look at here and to say, they're not just sitting on their laurels and saying, no, we invested in Fios. Let's give all of our money back to the people. It's like, no, they're investing in 5G. They're continuing to reinvent themselves, create things that are better products. And it's actually going to lower their overall capital employed over time, because as less and less people use Fios and they go back to 5G, the actual capital exposure that they're going to have in 5G is probably way less than what they had in Fios.
So one thing real quick. I don't think 3D Ammonia understands how TLT works. They invest in the long bond, which means, did we explain to him last time? Is this just like a troll account at this point? Because I feel like this might just be a troll. The 3D Ammonia thing.
Yeah, I think it's a troll. I don't know if he just doesn't listen when we talk about TLT, or he's just he's confused about what it means.
I'll do it one more time. As rates go down, short-term rates go down, that means that people will buy the longer dated bonds, to basically generate income. Because right now they're all buying short-term bonds because they can get 5.5% for it, which is happy for them. Great. The problem is when short-term interest rates start to get cut, they have to buy the long bond. So when they buy the long bond, that means that there's capital appreciation on that long bond because people are going to be looking for that yield. So that is the thing. That's why right now they're inversely related. So when interest rates started to get cut, right? Interest rates started to rise, the long bond ended up going down. Now, the opposite is going to happen if the Fed starts to cut interest rates, which in all likelihood is looking that way starting next year. So right now, people are saying, hey, inflation is dead and we might actually be going into deflation mode. So let's start buying up the long bond. That's why if you look at the last month, you can see the TLT actually appreciated about 4% on top of the monthly dividend that you're getting. Look at that. It went up 10% in 1 month. You see what I mean? This is the kind of return that you can get very safely.
So let's just talk about this briefly. Like the pandemic starts happening. They start cutting interest rates basically to zero. Look at what happens. It goes from 138, boom, all the way to 170, right? Then we kind of stay flat all the way to the point where we start talking about we're wavering. When are interest rates going to start rising? Everyone starts getting nervous towards the end of 2020. We're all kind of sitting there waiting. Boom. The beginning of 2022 happens. We actually start raising rates. TLT starts taking a huge nosedive over time, right? Now we're getting to the place where we're sitting. Okay, we do another set of interest rates here over the past 6 months. Now we're getting to the point where the Fed is getting on their back heels. They're saying, okay, we're thinking about taking a pause here. And that's when you've started to see, boom, this 9% rise here. And hopefully the thought is if they continue to hold back and rates continue, and I think maybe a good point is to to bring up, if you could, maybe the 20-year Treasury yield from CNBC, Kris.
Mm-hmm.
Let me just do that actually. CNBC 20
And if you
year.
look, this is a monthly dividender, by the way. So you'll get a monthly yield off of this. So it's not like you don't get anything for holding it.
So let's look at the past 5 years and look at the exact same thing. Let me share this here. So if you remember what TLT looked like, right? We cut interest rates in early 2020. Boom. That's when TLT went to 160, 170 bucks. And slowly over time, the yield on the 20 kept coming up till it kind of started getting to a peak here. Then it started to get cut a little bit. That's why the price went up. Then the last few months, we've had these races again. And now we're kind of retracing back. And that's what we're kind of hoping, is that this retracement goes from about 4.7, hopefully back down to something that's closer to the 2.5% range. So maybe it gets us close to what the price was in May of 2022. And the price in May of 2022 was, let's just see, 100, 112. So yeah, that's kind of the hope, is that we get closer to the 110, 120 range like we were back in May. Let me share this screen again. So May of 2022, we were kind of in this $100 to $120 per share range. So the hope is we kind of retrace to something that's a little bit more reasonable, right? We're not going to go back down to where we were, which was like the 2% range, right? Like I think that those days are over and done with, right? But what we could go to is the 3 to 3.5%, maybe in the longer term. Keep in mind, like this isn't the 1 year Treasury, right? This is the 20 year. So keep in mind that this isn't going to act exactly with the federal funds rate. So my hope is we kind of end up, in this closer to 3 to 4% range, which is going to show a massive move in the 20-year Treasury and massive move in TLT. And that's kind of the hope that people are trying to play on here, is that kind of massive move back towards reality, as we've been slaughtered over the past 6 months or so.
Yeah. So I think the person is saying, all I'm saying is we don't know what rates will be, and there are risk factors in a couple of the instruments you brought up. Everything when it comes to investing is a risk, but I think all the signs that I'm seeing, even among some of the talks that the Fed gave today, pointed to a lower rate environment that's coming up. So, it's good to be a little bit ahead of the time and generate that alpha while you can, and not to mention you still get paid to hold it. So even if, let's say, you have a flat TLT, you're still getting a 5% tax-free return, which is good. So if you got like a 7-8% dividend yield on something else with taxes, that would go down to like 4.5-5%. So you're getting 4.5-5% right now, risk-free, even if it flatlines, which I don't think it flatlines. I think it actually goes up. So
very good. All right, Kris. Well, we're over an hour. I don't know if you want to call it here or
I think we can call it here.
But we do have Snowflake earnings tomorrow. I don't know what your thoughts are. I don't know when they're coming out, but that could be an opportunity for tomorrow's discussion to cover Snowflake, and that will obviously have implications on a lot of not only AI, but maybe some of these cloud tool companies as well. I'm trying to see.
I'm just upset that I'm gonna have to shell out money to Adam Bergman, man.
There you go, man.
I mean, I'm getting memed, bro. I'm getting memed. No, I'm just
it goes to a good cause.
We'll do a fun episode, like me and Adam Bergman, probably on his channel. So I'll let you guys know. I got to pay Adam. He called it. He said Palantir was going to outperform Snowflake, and right now, as I look through it, I don't think there's a lot of room where Snowflake. I don't think Snowflake has a lot of room to catch up. I think the meme people have got their claws into the market right now. So the valuation of Palantir makes absolutely no sense, but that's just how the market is. Sometimes it's irrational. Like right now, Palantir's PE is 300, and people just bidding that shit up. So,
and what Snowflake's? I guess we'll see tomorrow. I know
it doesn't have PE. It doesn't have PE.
It's not the share-based compensation is too much still.
Yeah. yeah, its net
Yeah.
income's not there. So
Yeah. All right. Well, we'll get there. But even still, Snowflake's up 20%. I'm curious to see what
yeah,
it is on the news tomorrow. I think from the 2Q earnings, when we did it back a few months ago, they were talking about anemic growth or very flat growth for the second half of 2023. So I'm curious to see if they do meet that, or if they've actually been able to get some growth in the business. Just some thoughts for that one.
yeah, we'll see. We'll see. We'll see.
Yeah. All right, cool. All right, well, we will talk about Snowflake tomorrow. Is there any other companies you wanted to talk about tomorrow, or just Snow?
Probably Snowflake. If there's any that come up, we'll talk about it and see what we
And
can do.
I know my buddy Dave. He's back active on YouTube again. Hidden Freedom Investing. He is I actually need to meet up with him and get lunch or something with him. Just maybe have a beer with him because he's down in Galveston, so it's not far from me. He is back working, but he has a pretty significant portfolio. He's actually transitioned almost to all SPY and writing covered calls. But he also does write some options as well. So curious to see when he wants to get back onto the streaming universe. And he did like a 2-hour stream. What was that, on Sunday night or something like that? So he messaged me. He said he was down. I just didn't message him tonight because I knew it would probably be short notice. So maybe tomorrow or Thursday we can get him on.
Okay, sounds good.
Cool. All right, my guy. Thank you. Hopefully you get some rest, and I'll see you tomorrow.
Yep.
Cheers, man.
Cheers.
Later, all. Thanks for 100.